supply and demand still is the key on apartments or any real estate, really. Capital is the hardest component of real estate investment transaction. If you can't make a real estate investment work on the back of a bev nap, like a little notepad or something, it's probably a bad deal and you're probably making too many assumptions.
The problem with today's society is so many people are in a rush to build wealth. It doesn't work that way. What's going on, everybody? Welcome back to another week, another wealth webinar, and I'm joined here with Nick Sinatra. Nick is a local guy from Buffalo, so very rarely do I ever bring anyone from Buffalo on, and I thought, we met at his office, and I thought this would be a really good topic. Now, before we get in, I just want to tell everybody what you're going to learn today. You're going to learn a little bit about the journey that it takes to be successful. The journey in real estate is no different than the journey in other businesses, and Nick is a true test of that. I remember, and I don't even remember the year, my first flip was 2006, so it was anywhere between 2006 and 14. Nick was a rising star in Buffalo. He was buying up, it seemed like every single property I was looking at. And I remember there was this really beautiful property. It was a couple of duplexes right across from an old hospital, perfect developable lot. And I was looking at it through the lens of how do I buy this property, cash flow the property in its current condition or with a little bit of work, and then later figure out how to develop it. Nick was looking at it like, I buy this, I rip these houses down. I think you bought the hospital next door. I tear that down and I develop the whole thing. So you can see my mindset back then was very small. Nick was thinking huge, and that's exactly what he did. You all know the rest of the story. I didn't win the bid on that one. And I actually remembered hearing how much he paid for it. I'm like, is he crazy? No, he was actually way smarter than I was in what he's done. But he has done amazing things with real estate, from just buying rentals to developing. And now he's pivoted. And what he's doing today, I think, is really exciting. And that's what I want to get in. So Nick, welcome to the show.
Thanks, Chris. It's glad to be here.
Absolutely. So tell the audience a little bit about yourself and your company and what you've done.
Absolutely. So born and raised here in Buffalo, New York. That's where our headquarters is. It's where I am today. I ended up working in politics for a few years after I graduated college. I went to Yale and got the political bug there. And I went and worked for Governor Pataki in his economic development office for some time, and then went to work for President Bush down in Washington. And then I realized that wasn't the career path for me. So I went back to business school, and it was right around the time of the Great Recession. So I walked into business school in 2008, and that was the collapse with Lehman Brothers and all the guys on TV walking outside of Lehman Brothers with their belongings in their cardboard boxes, et cetera. So it was certainly an interesting time to be in business school, certainly an interesting time to be buying real estate. So when I got started back then, it was a little bit opportunistic, but also I didn't have much in terms of options otherwise. I went to the Wharton School of Business at Penn because of the real estate program, but I had no previous real estate experience. So trying to find a job in 2010, which is when the MBA program was done in the real estate world, was a difficult thing to do. So I started, much like you, I flipped a couple of homes while I was in business school, raised outside capital, flipped a couple of homes, and then I hooked up with an investor at the time, I didn't realize how deep the pockets were, but him and his wife were billionaires. He invested $2 million to seed me. He also invested on one of the house flips, and I had walked in when I originally got the money for the house flip. I walked in, asked him for a $100,000 check after I had been told no by 50 people. I was getting pretty discouraged, actually, and I walked in his office and asked him for $100,000. He wrote me a check for $200 on the spot. That's essentially how I started the company, because I used that money to go flip some homes. I brought it back to him with a profit. I actually used one of those big Ed McMahon checks, when I walked into his office, just to get a rise out of him, and he loved it. And then he put in $2 million to seed my company, and that was in 2010. We bought a 6-unit apartment complex, and it really wasn't a complex. It was a 6-unit apartment building with some storefronts in a suburb of Buffalo. And then I bought a few other properties, and we kind of grew it over time and took on other investors over time, and 20 units, 30 units, 70 units, 300 unit complexes like we buy now. And along that trail, we also got involved in development, like you mentioned in your intro, which has been a great business for us. We've built homes, we've built condo buildings, townhomes. We built apartment complexes. We actually, at one point in time, I was building Family Dollars and Rite Aids. So, back then, early few years coming out of the Great Recession, I mean, it was just an unbelievable time to be buying anything and building anything, honestly. We're now much more focused. All we do is multifamily. All we do is apartments. We buy and operate existing apartment complexes. We still do some development, but the main focus now is really buying existing and renovating major apartment complexes in upstate New York and Florida, mainly in Florida, but we are still doing some stuff in upstate New York. But that's the run of show, if you will, in a real quick snapshot. I've got a ton of stories in between that 13 years, but it was a really interesting time back then. Like I said, I started off mainly because I couldn't find a job. I think I interviewed at all the investment banks and the real estate firms in New York, et cetera. And, nobody was willing to hire a former political staffer with no real estate experience in that time frame, because it was just such a crazy time. I mean, most real estate firms were laying people off, not hiring. And so I decided to put together a business plan. I was always pretty comfortable raising money from my political days, and I had a decent Rolodex for somebody in their late 20s. And that's essentially how it got started.
So I got to ask some questions, because I remember those times. Was that back in the early days? Was that when you had the little office? I believe, was it on Elmwood or Delaware?
Delaware, yeah.
Delaware, yeah. I remember that tiny little office, and just always the rumors going around. But the relationship, we always talk, and everybody here knows your network is your net worth. So you met this billionaire. Just that wasn't by chance. Was it because of where you went to school? I mean, you were in that network of people that had money or had influence. Where did you actually come in contact with that person?
I'll answer that question, but I'll tell you a quick story about that little dinky office. So bought it in 2010, and it was in Kenmore, which is a first ring suburb of Buffalo, on a main street. We bought it out of foreclosure. It had been a used car dealership, and we bought it out of foreclosure. I don't know, maybe it was 200 grand, right? That we bought it, and it had a huge parking lot because it was a used car dealership, right? So I bought it, and then within 6 months, I was able to sell the back parking lot to a neighboring car dealership, because there was a huge car dealership right next to me. And so I sold off that little dinky lot for, I forget now, either it was 60 or 80 grand. So basically that was my down payment. So I had my cash back on the deal. We ultimately sold it 3 or 4 years later, because then we moved downtown. Our office is downtown in Buffalo. We bought a building downtown Buffalo, moved our offices there, and I think I sold the property for $375,000 or whatever it was. So it ended up being a great investment for us, in that time frame. And it's, essentially we flipped that commercial property, but I'm sure you've spoken to your audience quite a bit about, piecing off parcels and
Yes.
How sometimes a real estate parcel is worth more in its component parts if you break them up than it is as a whole, or vice versa. Sometimes you got to parcel up something to make it worth a heck of a lot more, right? So it's interesting strategy both ways. You can build it up or sometimes break it down. But yeah, in terms of meeting my original partner, it was a great story. He's since passed, but I met him, and it would have been a spring day in 2007. So I was working down as a staff member at the White House for President George W. Bush. I got a phone call that so-and-so wanted a tour of the White House, and I says, "Oh, it's too late. It's a Friday afternoon. I'm leaving, and the tour, you want to have a tour come tomorrow, and I can't get this person and his family through Secret Service clearance in time unless I personally did the tour and said they were my family, And I clearly didn't want to come in on on a beautiful spring Saturday in Washington. The person on the phone just kind of really pushed me on it and asked me for a personal favor, so I did it. And I'm glad I did, because then I met this investor who had two young kids at the time, and I walked him through the White House during a beautiful, beautiful spring day, and nobody was around because it was a Saturday. But then And the president at that point in time wasn't in the building, so it was even more kind of open and move around. If he's in the building, it's more restricted in terms of what staff can do and where they can go, et cetera. But he wasn't in the building, so I kind of had a really nice tour with him. And then lo and behold, the president is landing the helicopter on the south lawn of the White House, and so we walk out and we kind of watch him land the helicopter, and the kids were just going nuts. They just loved it, and so this gentleman was so thrilled by the experience. He took me for lunch afterwards, and it turns out, he's a big investor, and he's a benefactor he was at the time a benefactor for Yale, and loved the fact that I went to college there, and so we became friendly. And then, once I decided that I was going to strike out on my own, he was just one of 50 people that I asked to invest in the company at that time, and he happened to be the first yes, which is critical because, that's the question everybody, I'm sure your audience can attest to this. The question that you always get, like one of the first questions you get when you're out there raising money is, well, who else is invested with you? And if the answer is no one, it's
no one wants.
It's pretty easy to get rejected, right? But then if you say, oh, well, so-and-so, this billionaire family is invested with you, then all of a sudden, people are listening. They're like, oh, well, what does that guy know that I don't know? And if he's investing, I should invest. And that it sends, success breeds success. So that was a huge kind of pivotal moment in my life and certainly my career when I met this gentleman and his family, and then ultimately he became my business partner for 7 or 8 years, and then we ended up buying out his position and his family's position once he passed. Then we kind of bought out his estate at that point.
I think the interesting thing there is a lot of people think that, to get started and to grow, you either got to have money, you got to come from money, you got to know people. And this was just a random chance, but you did what other people were unwilling to do because it was such a nice day. And you actually, came in and gave them the tour. It just so happens the helicopter lands, and it's, for this audience, I just want everybody to know, he didn't start anywhere different than most of you. It's just sometimes that relationship and going out of the comfort zone or doing something that maybe you don't want to do that opens that opportunity that then paves the way for the rest. I mean, where do you think your life would be if you had not met that person? I mean, maybe exactly the same, but do you think anything would have been different?
Certainly I think about that often. I'd like to think that I would have found another series of investors or another person that really believed in me and that time. And also, again, don't forget the time frame. Any savvy investor had realized that the world had overcorrected, and that the buying at the bottom or somewhere near the bottom was a smart real estate move. So I think there was an element of this gentleman liking me and investing in me because he thought I would be successful. He told me once that he would have invested if I told him I was building widgets in Milwaukee. But buying real estate in Buffalo wasn't always necessarily a really appealing pitch either. A lot of times, especially back in 2010. The other element of it is realizing the space was ripe for buying at that point in time. I mean, I can tell you, when I graduated business school, I don't come from a wealthy family. I came from a very blue collar family. My parents, neither of them went to college, and we grew up in a restaurant business. My father owned a little restaurant, and then my brother now still owns and runs. But by no means do we have any generational wealth to lean into. So I graduated business school with $200,000 of student debt and maybe $6 in my bank account. I mean, I had nothing, right? And it's tough. It's tough at that point to make those decisions because as an entrepreneur, you're the last person to get paid. You're writing more checks. You're signing the front of more checks than signing the back of them. Put it that way, right? So you really got to have some gumption and some solid spine, because a lot of times it's scary not to have the paycheck. But the other element of it is opportunity cost, right? I didn't really have a whole lot to lose because if I was unsuccessful, I was early enough in my career. I wasn't married. I was single. I could live, at my mom's house or my brother's house or somebody's house, or rent a cheap apartment. My cost of living wasn't that high. I think as folks are later in life, it becomes more difficult. I'll tell you a quick story. When I was in the throes of fundraising unsuccessfully, when I was in the second year of business school, I was getting pretty discouraged. I leaned into a lot of folks I thought would invest and didn't. And I was in a class, a small little seminar, and there was a speaker. His name is Brian O'Neill, O'Neill Properties out of Philadelphia, and he was a short, kind of fiery guy, and he used vulgarity basically in every sentence that he spewed, and so I guess kind of loved his attitude. And he was an entrepreneur. He built his business from nothing. He was a used car salesman when he got involved, and flipped a couple of duplexes in West Philadelphia, and kind of grew his business from there, and his brother, much like many of your folks in your audience, and much like you did and I did. But what's interesting about him is I went up to him afterwards. I just told him my situation. I said, I'm getting very discouraged. I really have this dream. I want to start this company. I want to do X, Y, and Z, and I'm not having very much success. And he said something to me that really gave me the shot in the arm I needed at that point in time to keep going and keep fighting and keep asking for investors. He said, kid, he said, swing the effing bat. And obviously he said, the 4-letter word, but he said, look, he says, all you Ivy League kids think that you need to come out of here and making $250,000 a year or whatever. Your opportunity cost then becomes too high, because then, you go work for Goldman Sachs, and then you're making 300 or 400,000. Then you get married and have kids, and you just can't do it because your lifestyle won't afford you to be an entrepreneur. He says, do it now, swing the bat, go after it. He's like, when he started, he was a used car salesman. He's like, look, if I was unsuccessful, I just go back to being a car salesman, no big deal. I didn't have a whole lot to lose. And so, he's like, the best time for you to be an entrepreneur is now. And he was right. Shortly thereafter is when I made this big pitch to my original seed investor, and kind of the path was set forth there.
Wow, I love that story. And that is it. A lot of people just fail to swing because they think, oh, what if I'm denied? What if they say no? You're going to get no's. I mean, you mentioned probably 50, maybe this guy was 51. Like, a lot of people would have stopped at 2, maybe even 1. Some people might have had the thick skin to go to 10, but 50, that's a lot. And what I want to do is I want to transition the conversation a little bit into the different pivots you've had to make in your real estate career. Because like you mentioned, you started with flipping, and then you bought some small apartment buildings. And I remember you were buying some of those apartment buildings off Transit and over on Davison and Lockport, which, I never quite understood those. And now you've transitioned into what you're doing today. Can we just talk a little bit about those pivots? What prompted you to want to pivot, why you pivoted, and what led you to where you're at in this current day? And then I want to talk a little bit about some of the questions, like the commercial meltdown. Some of the people are talking about, the economy really stalling out, real estate being in a bubble. I just want to hear your take on some of that after we go there.
Absolutely. Yeah. Over the course of time, there were a bunch of pivots. 13 years, it was a good time to be investing in real estate these last 13 years. If I were to go back and talk to Nick Sinatra in 2010, I'd have a lot to say about pivoting differently, right? But unfortunately, in this life, you don't get a second chance at it. But when we first started, we were just buying whatever we can get our hands on. I had a very wealthy investor, and we knew the market was soft and oversold. We were just buying apartments, buying strip centers. I'd hooked up with a broker that was feeding me Family Dollar deals. We were doing that, and like I said, a couple of Rite Aid deals. And when you have unlimited capital, it's great in one respect, because capital is the hardest component a real estate investment transaction, right? I mean, real estate is very capital intensive, where most businesses are not as capital intensive as real estate. So when you have that family office that's kind of funding you without a whole lot of, I would say, guardrails around it, just kind of going out there buying, which at that point in time is fine, because the market was at our backs. Over time, we got more disciplined and just focused on apartments. But I wish I would have been more focused on apartments, frankly, back then, as opposed to doing some of the other commercial investments that we made. Got involved in development as a pivot. And it was more driven by my passion for my community here in Buffalo. I saw opportunities bubbling up in this area, and I thought to myself, I'm going to be part of redeveloping neighborhoods. So we started buying properties and redeveloping them using historic tax credits, in some cases brownfields tax credits, to clean up the site and then build on top of it. So we were, came from a good place, but real estate development is even more capital intensive than buying existing assets, right? So again, rewinding the tape, I would much rather have been buying existing apartment complexes and renovating them and increasing the rents than doing whole-scale developments, especially earlier on in our career when we were just getting rocking and rolling. Now we're much more comfortable with development, but as you're early on, not having that cash flow sometimes can be troubling, right? And then when we were doing a number of development deals, and fairly large development deals, like you mentioned, the hospital project that we were working on, and then our partner got terminally ill, and 6 months later after that, it died. And so the capital had all of a sudden went from being a free flow to stopping very, very abruptly. And you have all these development projects in the works, and that became problematic. So it forced us to pivot. And we pivoted into other investors, outside investors, as well as pivoting what our strategy was, where we really slowed down on development. We slowed down on anything commercial and really got more focused on apartments. And actually, we ended up selling almost all of our commercial portfolio to raise capital to buy out my partner's position, which ultimately ended up being very fortuitous because we sold all that stuff before COVID, and then owning commercial post-COVID for the most part has not been a great thing to own versus apartments. And apartments were strong pre-COVID and even stronger post-COVID from an asset valuation standpoint. I mean, I think collections in some states have been very, very disappointing during the COVID period, which is a whole other conversation. But I would say by and large, apartments have been a really strong asset class during the last 13 years without a whole lot of bumps in the road there. Even now with interest rates spiking, apartments are still holding strong. I mean, pricing's adjusted a little bit, but I mean, nobody's handing back apartment buildings to a lender like they are office buildings, and capital is still flowing into apartment sector versus in the office space, where lenders and capital is just kind of running for the hills on large city office buildings, right?
How often do you guys use banks for your deals? I mean, are you still heavily using traditional financing, or are you primarily just raising money from private investors and institutional investors?
Yeah, there's still lenders out there. So I would pretty much every deal we do has got some component of a commercial bank. Now the leverage points are lower and the terms are different, but there's still, for the right deals, especially because most of the stuff that we're doing new is in Florida, lenders are still pretty active down there. But we are using a lot of private lenders too. I mean, there's development deals that lenders are not as excited about, so we're using private lenders in some of those situations. And land deals, if we're doing a couple land deals here and there, that for the most part you have to use private lenders. But for apartments, especially if you buy, like we're buying an apartment complex in Tampa next month, and we had a couple lenders give us term sheets on it, and we chose one, and we're getting some really good terms on it. And now I'm having to guarantee that loan from that lender, which is atypical, right? Most of the apartment loans that we've done the last 5 to 10 years have been non-recourse through either Fannie Mae or a life insurance company or something else. And so that's a little bit different, the personal guarantee, but I'm comfortable with it. Somebody once told me about guarantees, like, look, it's scary if you don't ever intend on paying the loan back, but if you plan on paying the loan back, what difference does it make whether you guaranteed or not? It's not that simple. Obviously, guaranteeing a bunch of loans sometimes inhibits your ability to borrow new capital, right? Because the lenders don't like to see somebody that has all these contingent liabilities. But I've never been one to shy away from personally guaranteeing a loan, whereas some people just are adamantly against it, and will take higher interest rates or alter their business plan around it. I haven't really maybe that's the entrepreneur in me, I guess. Maybe I'm just a different stage in my life where I'm still much more risk seeking than some of the folks who have been in this business a longer time and more in the wealth protection risk averse mode.
James Davison asked a question that he said it was answered, but I do want to hit it again. He said all of your real estate transactions in Buffalo, New York area, and you mentioned Florida, but you guys manage everything now. But did you always manage all of your properties in-house, or did you used to use third-party management? And what made that switch if you did?
Yeah, that's a good question. We do manage all of our properties now. We don't do any third-party management. We only manage the properties that we own. mainly because it's really hard, right? It's hard to manage your properties, and it's hard to hire and manage staff, especially these days post-COVID. But property management companies, by and large, it's really difficult to make them profitable, right? So, the top 10 property management companies, they have enough scale where they can make it work. But for the most part, it's hard to make them profitable. But I also like to control our properties because it gives us an edge. We're closer to the property. We owning the property and in many cases having to promote with our investors to outperform. You really want to be able to control those levers, right? So if you have a third-party manager, all you can really do is asset manage them. And whereas if you own the assets and manage, the management company, if somebody isn't performing, you can take action, right? But to answer that question, it's a question I wish I would have asked. I would have been able to ask somebody 13 years ago, right? Because it's becomes relatively formulaic, right? But when I was starting off, I didn't really know this. But when we first started, we were self-managing, but it was sort of like I hired a maintenance man, and some people were doing work for me at night and on the weekends, and I was doing some work, and my partners were doing some work on it. And then over time, we got more professional on it. But people ask me that question all the time, and you could probably self-manage, in my view, to 20 or 30 units. And then at that point, you're going to have to establish a management company. So whether you hire it out or whether you want to go down the road of establishing a management company and hiring staff, which again, nowadays is a lot harder than it was, frankly, when I did it 13 years ago, right? Back then, people were dying to find jobs. I mean, it was people were sending resumes and showing up at my door to work, whereas today it's a lot more difficult to find the labor force. But by and large, I would say, between you and your friends and kind of hiring out this contractor, that contractor, it probably makes sense to about 20, 30 units. And then beyond that, you probably have to figure it out. And then, at scale, we only look at apartment complexes now that are 150 units or more because of the ability to keep that payroll on the property, right? So if you have a 50-unit apartment building, you're not going to be able to afford a property manager, a leasing professional, and 1 or 2 maintenance people on that site from the revenues of that property. So makes it less profitable. So really, our view is 150 units or more is a sweet spot to keep that payroll on site versus having to combine assets and send this property manager over here on Monday and Tuesday, and then over there, he or she's over there on Wednesday, Thursday. Same thing with the maintenance people. It becomes inefficient. And
I think a lot of people, like when they think about real estate, they think one of the biggest headaches is exactly that, managing. How many units do you have now?
At our peak, we had 6,000, but we've been selling a number of them into the strong market we had the last few years. So right now we have just over 4,000 units, apartment units.
That's a lot of management, a lot of toilets, a lot of tenants, and a lot of termites in some cases. So when people are thinking about they want to get into real estate, they really, have two paths. So like the path that you went on and that I went on, where you actually get dirty, you get down in it, and you just start doing it. And then you got the second path, which is basically you can be involved in the real estate, be part of the real estate, but just as an investor or a lender on that, which is now, I did my time, in the real estate. There was a lot of things I absolutely hated about it. And I always watched my lenders. It seemed like they always made all the money and they did nothing. It's kind of like they just collected checks every day, and I was out there slaving to make them and just to try to squeak out returns. So when I actually did what you had mentioned, I sold almost everything off, and we're still selling. And I just took the money and I just started lending it out and being the bank. And that's the path that I've chosen, and that's where Private Money Club came in. And, I'm like, I just need more deals to lend on, more good borrowers to lend on. And, and then, our paths crossed again because of a neighbor of mine and in a charity event that I was actually at, which is kind of what brought us back in contact. We never really knew each other outside of just both from Buffalo, and I knew Sinatra's because I used to go there and eat, and I thought it was great pasta, and I just love pasta. One thing that I've always respected that you do, and I got to be respectful of your time on that too, because I think you got about another 10, 15 minutes. So I want to make sure I get all the questions, but I want to really hit on one thing that you have done incredibly well, your entire career, and even better now. But that is the ability to look at and do proper due diligence on a deal to make sure that it's going to work? Like, did you have like a couple things you could tell the audience that you guys do that really, really has worked for you from a due diligence standpoint?
Yeah, like much of what I've learned on about this business, I've done it wrong the first time before I figured out how to do the right the second time. I was actually looking at one of our early transactions the other day because we're refinancing it, and I was looking at some old emails. I was trying to dig up some reports that I had done originally, and I just sort of saw how naive I was looking at all this due diligence, but it's obviously very critical now more than ever because the market's a lot tighter than it was, 10 years ago, right? So you got to really be thoughtful about it. I mean, we got this property that we're buying in Tampa next month, and I probably physically walked 10 or 12 other assets before we landed on this one. And within that funnel, maybe 30 or 40 that my team did the analysis on and kind of run it through our pro forma and our funnel. And then physically walk on the site and didn't like what I saw, or maybe felt like, we couldn't get the rent increases that we wanted to get, or maybe there was too much of something. Maybe, the neighborhood wasn't great, or the price point wasn't right for what we thought we were buying. There's a whole slew of things that that you can essentially use to get to a no. It's hard to get to a yes, right? There's 100 different ways you can get to a no, but over time we built a really great due diligence checklist. So now we have a standardized process. So I send a couple of folks on my staff out there first, and they have this kind of a standard Sinatra and company due diligence package that they go through, and my construction person, head of construction, goes to my head of acquisitions, and they kind of know what they're looking at, and they fill out this very extensive checklist and bring all the documents into an online portal. And then we go through them as a team, and kind of, again, I keep calling it this funnel because we keep putting it through this funnel till we get to like maybe 2 or 3 deals that we're going to put offers in on. So it's pretty extensive, and I think that's the maturity of the company that we have. Being 13 years in business, I certainly wasn't this thorough when I was just starting off, and I'm sure many of your folks in our audience don't have the resources or the staff to be that thorough. But end of the day, I think the due diligence is critical, and it can make or break a deal. But I will also say this: if you can't make a real estate investment work on the back of a bev nap, like a little notepad or something, it's probably a bad deal, and you're probably making too many assumptions, right? That was great insight I got from a mentor of mine early in my career. Say, at the end of the day, most good real estates are done on the back of an envelope. And if you're finding yourself having to, go to a third decimal point or something on a spreadsheet on an assumption, you're probably stretching. It's not going to work because you need room, right? You need room on these deals to have that margin of error, room on price, room on your ability to do the rehab, et cetera. There's that old saying that I think Mike Tyson said when he was a fighter, says everybody has a plan until they get punched in the face, right? And it's the same thing with real estate. I mean, we can have a plan walking in the door, but it's 9 times out of 10, that plan is altered by something, right? Whether it's the asset itself or some market condition or whether we bought a property in Florida right during that last hurricane, right? So there's all kinds of things that can happen. So you got to have a little wiggle room, right? If you're too tight in your assumptions and, you got to be perfect to make it, to land it, then, that's tough. It's tough to be perfect in this business,
I love that. And, it's kind of funny. Where I'm at now and where I was are 2 totally different things. And we've kind of gone through this cycle, these different ups and downs and different pivots that you've made. And, what I look for now is I look for all the things you just said. I look for people that are good at doing what they do. I look for people that only do one thing. Like that's all you do. We didn't really get into the workforce housing, but you guys have really niched down into a specific type of real estate that you've become just an expert at, and I've done the same thing in my profession of, becoming a specialist, in a very niche thing that I've become incredibly proficient at. But when I'm looking to place money and lend money, I'm always looking for those qualifications and exactly what you said, because I don't want to do all that work. I don't have the capacity to do that work, but I want that. I want the returns, I want the stability, and I want the safety of buying these bigger assets. So like I've been very successful in lending to this, other big developer, but you want more than just one person to lend to. So when we were talking in your office, obviously deep down inside, I'm thinking, okay, I've got a hedge fund, I've got money, and I've got an audience, and and maybe this is the thing I've been looking for to invest in. Now I'm getting ahead of myself because we kind of talked about it. I think you work with outside investors. Did you guys have a way that like myself or some of the folks on here, if they wanted to learn more, they could, get into your deals and lend or whatever capacity you guys are doing it, right?
Yeah, sure. Certainly. We sort of raise capital nowadays deal by deal. We more or less only work with friends and families offices. We don't do institutional capital. I went down that road. It's not one that we like to continue to do. We just like, we have over 200 investors that put anywhere from $25,000 to $50,000 investment up to 7-figure checks each time we do a deal, and that's what I like. And sort of that repeat investor. And certainly, you don't get to 200 without taking on new folks over time. Right. But anybody that's interested, they can just go on our website. There's an investor portal they can click on. Happy to talk to new folks. But you bring up a good point, for your audience too. I'll say this, specialization in all walks of life is the new way, right? I mean, nowadays the world is so sophisticated that specialists are always preferred, right? But in our business too, one of the things I would have taught myself years ago is to be more specialized earlier, right? Because you're able, if you really know your specific property type and your business model, it becomes, rinse, wash, and repeat, right? Every single time. And that's good for execution, and it's good to raise capital, right? I mean, you mentioned it, Chris. I mean, lenders and investors, they want to know that the person they're investing with and the company they're investing with knows that specific property type, right? I mean, if they want, if the investor is looking for, industrial space in North Carolina, then they're going to go find somebody that is really good at industrial space in North Carolina. I don't have to be everything to everybody, right? I mean, I want to be the company that does workforce value add housing very well. And then, folks will seek us out because they know that we have a track record of performance there, right? So that I had to learn the hard way, right? So it took me a long time to realize that. And if there's one thing I probably would tell myself 10 years ago is find your niche and get good at it early on and be that. Don't try to be something else. Just get really, really good at a one business model, and that will be how you can build your success.
Gosh, I always think of that Family Guy, where he's going around and, he's like, ooh, piece of candy. Ooh, piece of candy. Like that's how our careers were back in the beginning. It's like, oh, well, maybe I can do this. Oh, maybe I can do that. But then eventually you're so spread out and you're a master of nothing. And then you're just wondering why things aren't working. And then you bring that focus back into the one thing you're good at. And you just alluded to all that. And I love that. Folks, I put the link up in the chat. So if any of you want, it's, sinatraandcompany.com. I'll put it up there a few more times. But just in the last couple of minutes that I got you, James asked, are you rolling the sale of the assets you just mentioned, the ones that you're selling into new assets, deferring the tax, in other words, exchanging it, or are you paying the tax and sitting on the capital?
No, that's a great question. We have our interns here this summer, and I was joking with them the other day. I says, I've become better at tax planning than I am anything else. I'm encouraging them to take some tax and accounting classes in their final years of school, because what I've learned over time is to be really good at understanding the U.S. tax code, right? Because in our business, the real estate business, it's very favorable to the code. The tax code is very favorable to us, but you got to be really specialized to understand it. And what I found out is a lot of accountants really aren't even that good at it. You have to find very, very specific accountants that understand tax law and how to be most efficient with it. So to answer directly that question, it's a mixture. It's a mixture of what I'll call 3 different ways we do it. Sometimes we do a 1031 exchange, right, where we can identify a property and roll the proceeds from the first into the second property. We've also done a lot of opportunity zone work and development, which has allowed us to defer our gains into an opportunity zone structure on one of our developments. So we've become specialized there. Like, as I mentioned before, we've de-emphasized development, but we still have a pretty robust development pipeline. And it's all opportunity zone. It's all we do now is opportunity zone investment, partially because we want a vehicle to roll our gains into. But to your viewer's point, sometimes it just makes sense to pay the tax or try to offset the gain with some other maybe depreciation on a different asset, and go that way and have the cash, right? Because one of the other many things that I learned over time is you got to have cash on your balance sheet, right? And as a early entrepreneur, you got ants in your pants, and you say to yourself, "Oh, I got this cash sitting here. I'm just going to go invest it in something else," right? I mean, you don't want to really sit on cash, right? Because it's one more cool asset that I can go buy, right? But I think as a more mature real estate investor, you realize that it's important to have the cash on the balance sheet to be more proactive on dealing with whatever pops up, whether it's opportunities in the marketplace or whether it's something that popped up unexpected in one of your current investments.
Love it. And then I'll leave it with this last question, but there's a lot going on. You've ridden the cycle the right way, from the meltdown in 2008 straight up through today, but it doesn't take, a keen eye to notice that we're in a little bit of a bubble. I mean, real estate nationwide has appreciated substantially. The stimulus monies and everything else have really helped that. So one of the listeners is asking, how do you think the commercial real estate meltdown will affect apartment buildings? So I guess we'll just kind of streamline it to yours, to the job, the housing that you're doing now and the apartment buildings and everything that you're doing. Do you think it's going to have a big effect, or do you think it's going to be a big opportunity for you?
That's the $1 million question everybody's been talking about, right? And here's my view. I'll give you a more broad apartment view, and then I'll talk about the commercial space. So on the apartment side, I think it's very difficult to find a good deal right now in the marketplace where the numbers work. A lot of sellers are off on the sidelines. They're not selling in this market. So there's very, very few properties that actually are on the market. And in some cases, they all want too much for their property. So you have to really hunt with a rifle as opposed to a shotgun. And then if you find something, it's hard to get the financing for it. If you can get a deal to work, an apartment deal to work in this market with the high interest rates, and in some cases, high insurance costs, depending on if you're in a coastal market or whatever, high labor costs, all these other things that are in play. What I think is going to normalize, especially interest rates, when they come down and normalize a little bit, and the labor market's a little bit more back to where the mean needs to be, then the property is going to be really excellent, right? So you're going to get some market lift, the cap rate compression, however you want to describe it. So that's my sort of overarching view of the apartment sector. But I think the overall real estate space, I think there's a lot of pain out there in the commercial office space that folks are not acknowledging. You see it sporadically, you read an article in San Francisco, they're handing back this building. In New York, they're handing back that building. But if you just drive around and you see all this empty office space, especially the old suburban office space that's misplaced, what is that even going to convert to, right? I mean, it's empty now because people aren't coming back to the office as fast as they were anticipated, but they're certainly not going back to that office, that crummy B or C class office space in the burbs. I mean, they might go back to their cool office space in downtown, whatever city they're in, albeit smaller. They might go, the footprint's smaller, which is, whole nother discussion, right? But there's a lot of pain that's going to happen there. I think there's an opportunity for residential developers, because a lot of that office space, ultimately could be converted into apartments, but some of it can't be. I mean, some of it you just physically can't, because there aren't enough windows, to convert into enough apartments, right? So I don't know the answer. If I knew that answer directly, I'd be raising a fund around it. But I like to think that in our space, the apartment space, it's proven itself so resilient over so many cycles, and even with this last COVID cycle, and then now this interest rate cycle, that any large scale hit that the commercial lending environment took, or the commercial private equity world took, because of this commercial office pain, will be relatively specific to either those firms or those banks or that sector. I don't see it spilling over into the apartment industrial space again, I can't speak to retail. I don't know much about retail, and so it has its own drivers. But I can tell you, supply and demand still is the key on apartments or any real estate, really, right? And so the industrial space has been so strong because there's so much demand for it. Same thing with apartments. I mean, we're still underhoused in this country from a single family home perspective and a multifamily home perspective, especially when you get into the lower price points and then the affordable space. I mean, there's so much demand for it around the country, and that is going to drive a lot of it's going to buoy the sector.
I love it. I love it. Well, Nick, I know, time flies, but that was great. I really appreciate you kind of sharing your story, talking a little bit about the different challenges you had, the different pivots, and also now like the opportunities that you're seeing, where you're at now with getting really niche, and then also what you're looking at into the future. So I'm just make sure. Yes. So Katie, it's accredited investor only, right?
Correct.
Yeah. Yep.
Correct. Yeah.
So accredited investor only. But I put the link up. I'll put it up again, folks, if you want to, go online and just inquire deeper about whether or not you could be an investor, be a lender for the different projects. I like the fact that, you raise money per project instead of just kind of doing it like, oh, well, we don't know yet. I really do. I do like that because that gives people the visual of what it is they're lending on. Yeah.
It has its own challenges. Like, I mean, there's certainly an advantage to having capital assembled already when you're going to bid on properties, or it gives you certainly an inherent advantage, but it also has disadvantages in having capital that needs to be deployed and has the ticking time bomb on it that necessarily it kind of forces some bad decisions in some cases. So we like to do it this way. We're blessed that if we only got 1 or 2 deals a year, that's enough to keep the lights on and keep the engine moving. So that's worked for us.
Love it. Well, Nick, thanks for your time. Do appreciate it. It was good catching back up.
Thanks, Chris. Good to see you. Thanks, everybody. Appreciate you. Talk to you soon.
Thanks. You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up. All right, everybody. So there was one question that Rick put in, and it was perfect because I actually had Shauna send me this today, and I'd been talking about this, folks, and it's Airbnbs. We all know Airbnbs. Shauna rented an Airbnb when we went out to Utah and did Money Tank out there. Has anyone noticed that any of the owners of Airbnbs, have you noticed any changes in the bookings, the revenues, just overall? Like, I just want to try to play off of the audience here a little bit before I show what I'm about to show you. And yes, down. Okay. Katie said down, not just down once. Anything else? Costa Rica strong as ever. Well, yeah. One of these days I'm going to go out to Costa Rica and do some surfing out there again. Yeah, I was talking about bookings being only a week out as opposed to 2-3 months out. LA, Venice Beach, normal. Okay. So, we got some Venice Beach stuff is normal, stayed and owned. Okay. So here, I'm going to share my screen, and I just want to talk a little bit about this because here's the question. Rick said, I'm seeing reports of Airbnb market being down a lot. Are you seeing this as well? Is this changing your investment strategy in the short-term market? Would like to know if you think this is just a short-term trend or a market shift in general due to saturation of rentals. I don't think it's saturation of rentals. So I'll give you my take on that. But let me just show you what, and there's lots better info, but this is just what we had here right now. The Airbnb collapse is real. Revenues are down nearly 50% in cities like Phoenix and Austin. Now, Phoenix has suffered terribly for Airbnbs. I would say there's massive saturation in places like Phoenix for Airbnbs. Watch out for the wave of forced selling from Airbnb owners. Ding, 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 opportunity later this year in areas hit the hardest because, well, here, look at it. Tennessee down 47%, Phoenix down 47%, Austin, Texas down 46%, Myrtle Beach, San Antonio, North Carolina, Salisbury, Nashville of all places down 39%, Denver down 38%, Breckenridge down 37%. So when you look at these numbers, these are real numbers coming in. Sorry, it's on a, I don't know if this is a tweet or just no, I don't know what it is, but you can find these numbers. And I've stayed away from, and I think all of you know this, I've talked about this. I've completely avoided Airbnbs. I have not lent on Airbnbs. During the pandemic, I think I probably lost out on some good opportunities in Airbnbs. I think there's still pockets in this country where Airbnbs will continue to be a great investment. I think they will continue to make people a lot of money. But for me, the thing that always scared me about it is people were buying Airbnbs and paying big money because they could support it when they were booked out 2 to 3 months. But as the market starts shifting and as people stop the charade, which is, I call it revenge summer. If you remember last summer, Airbnbs were hot. Everybody was talking about them. Everybody was an expert. There was this coaching plan and that coaching plan. Sound familiar to Bitcoin? Yeah, because the year before that was all Bitcoin. This coaching plan, that coaching plan, they all kind of fade out. I'm not saying either are a bad investment. It's just when I look at things, I'm looking at them through a different lens. And I just saw that when everybody's running towards something, I talk to Sean about this all the time. I'm typically running away from it. So if everybody's running towards something, I'm saying, nope, I want to run the opposite direction. Now, I'm not saying that that's right or wrong. It's just me. And I think here it probably served me well to stay away from it because as people kept buying and buying and buying and prices went up, they didn't care about the price of the property because, well, the numbers penciled on, it being rented the way that it was last year and into this year. But as these rentals, the bookings have come down significantly, like we heard some people talking, and like those numbers show, all of a sudden now people are not going to be able to stabilize these properties. So then they're either going to have to do one of two things. Sell the property, which obviously we're coming off of our highs. Arizona's way off of its highs. San Francisco way off of its highs. Salt Lake and certain parts in Utah off of their highs. And that trend will continue. As interest rates keep going up, Jerome Powell just said in the news, and I just did it on WTF, that they're not going to slow, they're not done raising rates. They paused because they want to wait for everything to catch up and see what's happening. But what you have to understand is these rate increases we've seen, 5%, 10 rate increases in the better part of a year. I mean, that happens so fast that industry hasn't really felt the pinch until recently. I mean, think about that. The lines of credit. Now, all of a sudden, what used to be 3 is now 8. What does that do to your bottom line if you own a company that relies heavily on lines of credit to buy inventory? And most businesses do, just so you know. Businesses are cyclical. They got to ramp up, buy all the inventory and sell it. Now, technology has helped that, but the same thing for Airbnbs. Like, if you paid the top of the market, what is your exit? Well, let's Airbnb it, but now bookings are off 30 to 50%. So now you're not booking. Now you're not getting the revenue. Okay, what's the next one? Long-term rental. Are you going to be able to stabilize the price you paid for the rental or for the Airbnb by renting it? I bet you the answer is on the back of a napkin. The answer is probably just no. I don't even need to see the math. I'll almost bet any money it won't pencil. So these are the things to be concerned with. I'm not saying that Airbnbs are dead. I don't think they're going away. Actually, I like them very much. Me and Shauna, when we stayed at the one in Salt Lake, we loved it. It was wild. You get to experience a whole different thing because it's not a hotel. But I still prefer going to hotels because I like consistency. I like going in. I like knowing that I can get my coffee in the morning. I like knowing where things are. I like knowing my beds are clean. And yeah, listen, that's just me. But I also like getting out of my comfort zone and doing the Airbnbs. So I mean, I don't know what everybody else thinks about it, but it is definitely something that you have to look at. Because from the opportunity standpoint, is a lot of these people that have these Airbnbs in these areas we're talking about, they might not be able to hang on to them. And it might create a really good opportunity for somebody to buy it for a different use. And that's kind of what Nick was talking about, right? Commercial space. A lot of these commercial spaces are going to have to be, you're going to have to find a new use for them. When shopping centers and shopping malls and big box stores started really kind of falling apart after the pandemic, drive down any street in any town, what do you see? Big storage facilities, right? So you can see they've repurposed these big boxes. There's always going to be change and everything. And you just got to be ahead of the change. You don't want to be caught in the change. You don't want to be caught with your pants down. You don't want to be the person that was last in, right? Did you want to be the person that was buying Bitcoin when it was 50 or 60,000? Oh, you were? Yeah. So I don't want to give any of your names, but yes, you don't want to be that person when you're in Airbnbs or in real estate or, well, so be it told that Bitcoin, that caught a lot of people off guard. But the funniest thing is nobody talks about the problem when it happens, right? When they face they want to talk about it when everything's going good, right? Bitcoin was the #1 thing, like, oh, infinite banking. Why would you do that? Put your money in this crypto and you'll make way more money. And, and all of a sudden, then all those are gone. Airbnbs, we don't hear people talking about them all that much anymore. You sometimes just doing things that have been around for a long time, like the infinite banking concept. We talk about it all the time, and I'll show you some things with that. Been around for hundreds of years. Whole life insurance, boring, been around for hundreds of years. Okay, so when you have something that's got that long consistency, that sometimes gives you comfort. Now, I'm not saying that's for everybody, but for me, I like consistency. I like consistent and predictable returns. And I just like knowing what things are going to look like in the future the same way they do now. I don't always get it right, but by not striving to go after the hot thing, the thing that everybody's talking about today, then sometimes if you just go with the steady Eddie, everybody looks down on you because they say, oh, that's boring. Why would you do that? How come you're not buying crypto? Why aren't you buying Airbnbs? Why aren't you doing this? And you say, I don't really know anything about it. And that's the third law of wealth. Protect your wealth, invest in things you know, like, and understand. So that would be my thing, I would say. And then they're making a bunch of money, but then all of a sudden they lose a bunch of money. Who was better off? The person that made a bunch of money, got used to living at a different level of income that wasn't sustainable. Now they're losing money and now they got to recorrect. Like me, I'm just like that, slow and steady. How many of you just like slow and steady? I mean, it's not going to be all of you, but I'm sure there's some of you on here. If you're thinking about your retirement, how many of you just want to know the check's going to show up every month? You don't really care to grow it to be huge. You just want to know that the check's going to show up every month. Well, that's definitely, the path that I go on. And I think a lot of what we teach with the infinite banking concepts in whatever capacity you're looking at. I mean, this is from the last 3-day, preserve and protect. I can't stress how important that is right now, because yes, it seems like there's lots of opportunities out there, but I still say it's a bit early. And I'm not, listen, like, lazy money is never good money. But somebody, and I don't know where I was talking, but somebody had put on there, do you think having cash is a bad place? And certain people are like, yeah. Oh, it was just the other day, I was doing a podcast, which you'll all see, with a local investor here. And he was saying, oh, having money in the bank is not a good thing to do. I would rather take the money in the bank and buy another apartment building. And I'm not disagreeing with him, but I'm also, and then he was saying having the money in the bank, it's like losing, 4, 5, 6, 7, whatever percentage inflation is. And I said, yes, but let me try this one. Having money in the bank, let's just say right now you're going to lose, let's just go 5% to inflation. It's not quite, but let's just use 5%. Okay. It's about double where the Fed wants it, which is 2. So if you're losing 5% to purchasing power to inflation, yes, that's not good, right? And a lot of people are like, oh, that's bad. Well, I can show you how to solve that, a short-term problem, because that's what it is, short-term. I can show you how to solve it with a short-term solution. And I did throughout all last year. I said, buy TIPS, Treasury Inflation Protected Securities. You all of you that bought TIPS like I did, you paced inflation. You crushed inflation, as a matter of fact. You probably got to a point where you were making way more than what the inflation was, what inflation was. And then I said treasury bonds, and I give you all these different things. Those are short-term solutions. But then there's the person that says, I'm going to take the cash and I'm going to go out and I'm going to do this flip, or I'm going to buy this apartment building. And I'm going to buy it at the high because, oh my God, I can't have money sitting in cash. Then all of a sudden, the apartment building starts to lose value. The rents are getting harder and harder to get what you want because you had to support the carry cost. And your carry costs are pretty close to just going and doubling. Now, what do I mean by that? Well, if you know anything about commercial mortgages through banks, typically there's a lock period. Sometimes it's 5 years. I had a lot of 5 years. Sometimes it's 7, and I've seen 10. You all know what I'm talking about. So when those locks come off, you basically have to reset at the current interest rate or refi at the current interest rate. I'm going through it right now. And I'll tell you, some of those mortgages were 5% on a commercial mortgage. They're resetting at 8. For me, that's okay because I'm already on the tail end of selling everything. Like Nick was selling a bunch. I'm pretty much almost done selling everything. I'll maintain and keep 2 of our properties because they are token properties that I don't know if I'll ever sell them. But anyway, that's neither here nor there. But the thing I'm trying to get at is sometimes when you're in a rush to place money to solve a short-term problem, you create a long-term problem. And I'd rather have a short-term problem that's solvable than have a long-term problem that's really difficult to solve, right? Just consider that. Right now, having cash on the sidelines, yes, I know you're losing to inflation. We teach all the time how to beat the inflation or hedge it. But don't be afraid of cash. You know, a lot of people, if they've got money in their infinite banking policies, like, for example, just today, and actually it's been like 3 weeks, and I'll just tell you what I've done. So I've got a bunch of policies and I put a lot of money in. So I make money, you know, a lot of my income is 1099. I also take a salary from one of my companies, which is W-2. Okay. So, you know, I've got all these different things, and then I've got interest income and everything else. But, you know, I funnel a lot of that. I funnel all my savings. So if my monthly expenses for my just living are, let's just say 15,000 a month, I don't know. I mean, that's probably close for everything with Vivi and not my house, because my house is owned in a trust, but let's just say that's that. Anything extra that I would make, I would put into my policies, which are all specially designed whole life. And then every time, and I have limits, every time these accounts get to a certain level, like my personal accounts, if they get over $20,000, I'm freaking out. And I'm not freaking out for the reason that most people would think. Like, people freak out when they look at their bank account and they've got not enough money in there, right? I used to always do that. How many of you freak out when you look at your bank account and there's just not enough money in there, right? That's a bad feeling. But imagine now you freak out when you have too much money in the bank. For me, in my personal accounts, if I have more than 20 grand, like, I'm freaking out. I don't want more than 20 grand. So I will very quickly try to get anything more than that 20 grand back into my policies. Now, the other thing that I found a while ago, and you've all probably seen them, but Rob and Nicole Fuller, okay, and I'm just going to call it ROI Properties is the name of their company. And this isn't a commercial for them. I'm just using them because I literally just did this again today, and I did it last month as well. I have in my business accounts, I have what's called a war chest. It is just like I teach all the time. It's a separate bank account. That's all it is. We just call it the war chest because that sounds better. Oh, so, you know, what do you do with the excess money? It goes into my war chest. What is the war chest? It's a freaking checking account, but it's for my business. Now, the war chest, we have a rule. It's our opportunity fund. So right now, the amount in the war chest is 100,000. Like, that's how much we always want in the war chest. We also have a reserve account, which we always keep at 50,000. This is business. Okay. I want to clarify. Business, the amounts are higher. Personal, the amount is lower. 20,000 is my rule for personal. And listen, folks, put your numbers in however you want. And then over here in the war chest, 100, this is an opportunity fund. So, you know, when everything starts to fall apart, if I have money, I can hire more people. When everybody has to fire people, I can keep my current staff going and operating when everybody else has to lay people off. So you can see I can gain market share because I'm sitting on money in cash. But here's what happens. You know, as I make more and as I get more money, I keep filling the war chest up. It's just one fun. It's like a waterfall, right? You guys have all seen water. It flows down, and then there's a pond here. And then eventually when this pond overfills, it flows down again. You've all seen how waterfalls work. Well, this is how my finances work and how yours should too. You're waterfalling money. My W-2 and 1099 flows over to here. I send this money out to work all the time. Okay, let's just use Rob and Nicole Fuller. And then whatever money I have over there, you know, so my money here is working. They pay me interest, 12%. Actually, I'm sorry, I hit a milestone. So I'm now at 13%. Some of you are at 14. Some of you are at 15. I'm sure there's one or two of you with the Fullers that are at 16. Good for you. I'm coming after that too. See, they have tranches for how they do theirs. At certain dollar amounts, you bump up to a higher interest rate. So I got to raise 1%, which doesn't sound like a lot, but it actually is. It's quite a bit when you actually play it with a lot of money. Now I take that money that I get from them and I flow it back over here. But in my business account, what I've done and what we've been doing is when this breaches 100,000, I also send, and this is not through the policies, shame on me, but I then send the money from the business accounts over to the Fullers. And I set up a corporate account over here and they pay me interest from that, which comes back over here. What do you think happens? This starts to get to be more. And as business does well, and as we profit, more and more money goes into war chest and more goes into reserves. And because I have rules, I waterfall that money and I send it back over. Now it's a self-perpetuating problem. I don't know if you caught on to that. It's a self-perpetuating problem. The more I send over here to make work for me at a higher interest rate to pace inflation and earn money with a lender that I very much trust, and I've done more research and due diligence on them than I ever have any investor in my entire life. So I'm incredibly comfortable with them. to the point where I don't really recommend anyone do anything with their money. Like I'll say, hey, there's private money club, pick who you want to lend to. But I do say, I very much trust them. And I think any of you that were looking to place money, like you should really consider talking to them. I'm not making a recommendation, but this is where my money's going. And I feel very good about what they're doing. And what Nick just said solidified what they're doing as well. But as they pay interest, the money keeps building up the same damn problem I had. And I keep breaching the 20, breaching the 100. And then all of a sudden I got to redeploy that money. So as I keep doing this, I just keep thinking more and more. And I'm just like, people are always asking, you know, why would I need more than one policy? I just explained it. I started with one policy in 2004. That policy, so I'm just going to take you through history. That policy in 2004, I put $240 a month into it. I was roughly about 24 years old. I put $240 a month into that policy. That's a very small amount of money. But I want to be very clear about something. When I did that in 2004, that was scary to me. That 240 was a lot of freaking money. It was a stretch. I didn't know how I was going to make, you know, and back then I was thinking make those monthly payments, but make those premium deposits is what I should have been thinking. But see, I hadn't changed the mindset in 2004. And then in 2006, you know, 2 years later, I did another policy. Why didn't I just put more in the first one? Because I couldn't. Okay, I was past the 2-year window. So here I started another whole life. A New York life, custom whole life is what I did. And I don't remember the exact amount, but it was a little more than $500 a month. So now I'm putting 240 in this one. And then I start this one at a little more than 500 a month. I freak out again. I'm like, oh my God, I don't know if I can do this. I don't know if I can make the $500 monthly premium deposits. But you see, as time went by, this just became normal. Let me just pause real quick. How many of you have done something similar where you've started saving? I don't care if it's a 401k, I don't care if it's an IRA, or maybe you're on your way to doing one of these specially designed whole lives. And at first, it made you really uncomfortable. You looked at the dollar amount you were going to put in, either deposit or investment, and it scared you. But then 3 months, 6 months, a year later, you're like, you completely have forgotten about that money. You don't even remember putting it in. I know Shauna has. So Tess said that. So Katie said that. Really, just 2 of you? Nobody else has done that? Drew said that. I've just kept doing this. I just kept adding more. And I kept adding more because I made more. W-2, 1099, interest, you know, on my money, working, investments, real estate, all these different things, which are always over on the right side. I call this the opportunity side. Okay. As I've made more, I've been able to add more. So it's just taken time, folks. Like I didn't just come out swinging. I'm not Devin Burr that, you know, like where, you know, I had like a good base that I could just come out swinging, and good for him that he could, but I didn't, that just wasn't my path. My path was struggle and suffer a little more, struggle and suffer a little more, but it gets easier and easier. You know, I think it went 1,000, then it went like 1,500, and pretty much even today, and I know a lot of you don't do it this way, I still make most of my premium deposits monthly, because that's the way I've trained myself to think. I think on a monthly basis. I set my budgets on monthly basis. I meet with my bookkeeper and we plan monthly. We even now do weekly. So, you know, annually, I just haven't got there. I do have a couple policies that are annual, like I got a $30,000 annual one, but you can see each one of these are just layers. They're waterfalls. This one waterfalled this one, this one waterfalled this one, this one waterfalled this one. And then when I got smart, I started learning, you know, from Brent Kessler, I started learning that the fastest way to wealth is through your own debts and expenses. And holy crap, in those early years, I mean, all the way up to, we'll just go right to this one, because this $1,500 one, I didn't really have any debts because I was doing it. But, you know, I think 3, 4 policies deep, I was severely in debt. And Brent then taught what you've all seen: take a loan from your policies and you pay off the debts. Now, as we all know, the loan on, and people are always, the haters come out on Instagram and all these things. They're always hitting me up. Oh, no. You're not recap. So we always talk about pay yourself, you know, with Be Your Own Bank, pay yourself back with interest. And here's how they always hit me. They always hit me. You can look at any of my YouTube videos. Oh, you're wrong. You're not explaining this right. That interest that the insurance company charges, that doesn't go back to you. I'm just like, oh my God, for crying out loud. There's 3 interest rates we're talking about. Number 1, we're talking about the interest rate the insurance company guarantees you. Okay, which by most standards is anywhere between 3 and, well, I have some of the old ones, which are 4, but 2 to 3.25 today. Okay, the old ones were 4. That's guaranteed interest, interest number 1. Interest number 2 that we talk about, the interest rate that the insurance company keeps. Okay, we'll just put insurance company keeps. That's the 5%. Used to be 4. This is simple interest. This is compound interest. Learn that first. The difference between compound and simple interest, and you won't ask the stupid questions, you know, like the TikTokers ask all the time. Interest rate number 3, the interest rate of my money working for me. Money working. The best thing, and this is why I talk about it so much, the best thing about your money working for you is the number 1 place your money should work for you is to pay off your debts. We got credit cards, anywhere between 10 and 30%, 29.99, close enough, right? How many of you would want to make 10 to 30% with 0 risk? All of you. So pay your credit cards off. Take the loan from your policy, pay the credit card off. Oh yeah, but we got to give the insurance company the 5%. Yeah, but you know, the insurance company also pays you dividends. So with dividends, every company we work with is north of 5%. I think our lowest is 5.2. You're still making money there. Who cares that you got to pay the insurance company money? They're paying you more than what they're charging you. Do we really care? Oh yeah, but the insurance company keeps that. Great. So right now, idiot, you're paying money to the credit card company. Like, you don't even complain about that, but you're complaining about the insurance company charging you 5 when you're giving Visa 29? Pay the credit card off, and then just, hey, you want to make this simple? Great. You're paying 15% interest to the credit card. Okay, this is what you're paying. And now you're only paying 5 to the insurance company. So subtract 5, you still net 10%, smarty pants. So now we take this 10% and we just pay back the loan to the policy. Every time we pay the loan back to the policy, this 5% is charged on a lower balance. So this one's declining, this one's increasing. Simple versus compounding. I know it's getting sloppy, but is this making sense? There's 3 interest rates we always got to think about. The guaranteed interest rate and dividend that the insurance company pays you. The interest rate is guaranteed for the rest of your life, never changes. The dividend can change. And good news, interest rates are going up. The Fed's making sure of that. As interest rates go up, treasuries, government bonds go up. The yield goes up. What does that mean? That means your dividends in the next near future probably, I can't guarantee, but probably will start to go up. Historically speaking, that's what's happened. This is, I'm getting really passionate here, folks. This might be the single best time of your life to do what I teach. I just got lucky because we've been in a declining dividend scale for 34 years. Figure it out. Go back and do the math. 34 years, interest rates have been on a downward spiral, which means dividends have been on a downward spiral. I have the charts to show it if anyone ever wants to see them. For the first time in my professional career, because I haven't been doing this for 34 years, I'm only at about 20. I'll get there, but I only at about 20. For the first time, it's reverting. Dividends are now starting to follow the interest rate cycle. These are your dividends over 34 years. They've gone down, 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 down. We're looking at dividends right now at what might be the lowest dividend in the last 34 years. And now we're already seeing it. Guardian just raised their dividend. All the companies just talked that we just went to, all mentioned. They didn't say yes or no, but they all said, yeah, it's likely that dividends will go up. They didn't say our dividends going up. They won't say that. But there's a very strong probability we are at the cusp right here. I don't know, CUSP, I think is how you spell that. The cusp of dividends starting to go back up after 34 freaking years of them going down. I talk about all sorts of opportunities. I talk about, you know, Nicole and Rob being an opportunity. I talk about, you know, Sinatra and Company being an opportunity. I talk about flipping forklifts being opportunities. I talk about all sorts of opportunities, but this opportunity is probably the biggest one because this opportunity will benefit us for a very long period of time. This will be the first time in my professional, well, in my life. Okay, let's just be honest. I'm 45. This will be the first time in my life that the illustrations that I've given almost 8,000 of our clients are probably all wrong. They're probably all wrong. They probably will never, ever look like the numbers on the illustration that we all love, that we look at, that everybody's like, oh, that's so cool. They will probably all be wrong because there'll probably be more in the future. Like, think about that. There'll probably be more in the future. I have never been able to say that. I just did, though. Hopefully I don't get my hand slapped for saying that, but that's freaking cool. And if we just understand this stupid little thing that I said, then why are we so focused on all the things that don't even matter? Everybody, what do they focus on this whole thing? Like, oh, I'm making a net of 10 and I'm lending the money out at 12, which hell, 5 minus 12 is still pretty good. Like the only thing so many people want to focus on is this, the money the insurance company's charging you. Folks, they're charging you interest because they're giving you money from their general account. They're not a nonprofit company. None of you want the insurance company to be nonprofit. Trust me. You want them to make stupid amounts of money. Did you hear Nick? Nick was like, insurance companies lend him money. Duh, of course they do. Insurance companies have all the money. Like he flat out said that. He doesn't even know. Nick doesn't have a clue what I do. Not a single clue what I do. I've never had a discussion with him about what I do. Never said infinite banking. I might have mentioned PMC and Private Money Club. He had no idea. Like, and he said insurance companies lend him money. They have all the money. So like we want them to make money because the more they make, the more we make, because that's what their dividend is, right? A dividend is a return of unused premiums. Dave Ramsey says that's a bad thing. Dividends are a return of unused premiums. All those greedy ass insurance companies, all that dividend is them just giving you your premiums back. Yeah, exactly what it is. And Dave, Smarty Pants, that's getting sued for 150 million bucks. Do you realize that because they're just returning your unused premiums, it's tax-free, bud? So how about IBM and GM and Apple and all those dividends? Are those tax-free? Oh, no. Unless you own them in a Roth IRA, they're not tax-free. So who's the smart guy now? Dave, who said, that's terrible. They're just killing you. They're making all the money. They're just giving you your premiums back because they're overcharging you. Really? Because I've looked at the numbers, Dave, and tell you what, I actually think they're overpaying me, but I'm not going to tell them that. It's just silly what people want to focus on. You want to get wealthy? Start with the easiest money, which is your debts. Then from your debts, hell, what I maybe don't do the best things with it. I don't like risk. So like cars were next for me. A lot of people are like, oh, I don't want to pay off my car because I got a car loan for 3%. I had one of those. Watch my YouTube video. I had car loans that were 3%. You know what I did? I borrowed money. Interest rates back then were 4. I borrowed money at 4 from the insurance company to pay a car off at 3. Does that make any sense to anyone? Like I've got about 100 people on here. Does that make any sense to anybody? Why would I ever borrow money from the insurance company at 4 from my policy to pay off a car loan at 3? Does that make anyone any sense? People that have been around the campfire test is like, yeah, it makes perfect sense. Mike's like, yeah, it makes perfect sense. But I know for a fact there's some of you on here that are like, no, these people are smoking something here. Yep, they're all drunk. They're all drunk. I don't understand why that would make any sense because, 4 minus 3, well, you're losing 1%, right? You missed the point. Simple compound. So the one thing people don't ever look at is, the interest rate we're earning. So let's just use 3% just to make this like bad. They pay a little more than that, but people would be like, you're only making 3 and you're paying 4? Yeah, but I'm making 3% compound interest and I'm only paying 4% simple. And the average person that hasn't been around this campfire, and if you have any of these people in your life, please invite them. Have them come watch this webinar. Have them watch your videos. Have them read books. Like just don't try to tell them why they're wrong. Just say, oh, you just got to see it and you'll understand. Compound interest will always beat simple interest. It's math. Albert Einstein understood this, but yet the average person just wants to just look at it from the surface. 3 minus 4 is I'm losing 1%. 4 minus 3, I'm losing 1%. Why would I do that? Because this, but who cares? Let's just take this out, right? Let's take the compound interest piece out. And let me tell you why this would still make sense. I pay the insurance company 4%. The car, I only pay 3%. The average car payment right now is $800 a month. I just saw a stat on that this morning. So I'm only paying 3% on my car loan at 800%. I know if I take a loan from my policy, that stupid whole life, I got to pay them 5. Let's up the ante because right now it's 5. Let's get out of the old day. 5%, okay? So I got to pay 5% and I've got a really good car loan at 3%. Every time I'm paying this car loan off. And here's why. This $800 a month, that ain't no small amount. That's not a small amount of money. $800 a month. People sometimes have to work a lot of hours for that. Sometimes that's a big chunk of somebody's monthly salary. That's a lot of money. And that's cash flow that's not going to my family. That money is leaving. We're just going to have this money go right off the page. It's leaving my family forever. I'll never get that $800 back. Oh, but I got a car. Yeah, what's that car going to do? It's going to depreciate. Yep, sure is. Okay, I got a car for that $800. I take the loan at 5. I pay off the car at 3. I take the $800 of money that I used to give away, and I take that money and I put it back into my policy, and it's called recycle, recapture, but let's just call it a loan repayment. I'm going to repay the insurance company the loan that I took out. But really, whose money am I repaying? Mine. It was all my money from the beginning. Well, no, it wasn't. It was the insurance company that lent the money. You said your money never left your account. Yeah, but the death benefit's mine contractually. I know I got to die to get it. But that shit's mine. I pay for that. I own that. That death benefit is all mine. So even if the insurance company lends it, I want that death benefit back. So by repaying the loan, you're reinstating that death benefit, which means what? You're reinstating every penny that you then get to use. But here's the thing that they don't understand. They're still caught up on the 5 and the 3. They're like, dude, you're an idiot. You're losing 2%. I'm taking $800 a month back. I'm getting cash flow back in my family. I'm getting cash flow back that I can go to dinner with. I can go on family vacations with. I can pay college tuitions with. I can go pay groceries with. I can pay the exorbitant inflated price of everything with. But not only that, the 800 is coming back to my policy, which means it's reducing the loan, which means the insurance company, even though they're charging me more than what I was paying the bank, I'm paying the loan down, and I get to control all of the money. Because people will then say on social media, you know, they'll come in and say, yeah, but when I was making the car payments, I was paying the car loan down too. Right, you were. And you were doing the same thing I just told you to do, except for there's one big difference between you, smarty pants, and me. I got $800 a month and you don't. And at the end of this whole thing, when we're all done paying these loans off, I got all the money back for that car and you didn't. You just got a rusty old car in the driveway that's worth a hell of a lot less than it was. And I got the same rusty old car that's worth a hell of a lot less, but I got all the money back because I changed one freaking thing. And that was where my money went first. But I didn't just jump right in. I dove in slowly over years. And the problem with today's society, none of you folks, but the problem with today's society is so many people are in a rush to build wealth. It doesn't work that way. Hey, maybe you'll get lucky. Maybe you'll be, you know, at work and somebody will ask you to give a tour and you'll meet a billionaire. Maybe, probably not. Maybes don't exist in my world. Luck doesn't exist in my world either. Luck is a made-up number. It's a made-up word. Luck only exists because of opportunity. When you start finding opportunity, luck comes next. When you chase opportunity every day, luck comes next. It's just a made-up word, folks. So I want to conclude with this. I want to hit some of your questions, but I certainly, you know, we started with Nick talking about real estate. And then I went into some of the things I'm doing in my waterfall approach and how I'm taking money and I'm just taking the money right off the top. I'm skimming the top, just like gambling, right? You get up, you should skim the gains off. I don't gamble, but same idea. Just take the gains off. I'm skimming the gains off and I'm sending that money over to Robin and Nicole to work for me. Like, if you're not having the conversation with them, you really need to. If you're on the fence for one reason or the other of why you should or shouldn't, like, talk to them about that opportunity, you really owe it to yourself. You have to. And some of you are like, well, I don't have 100 grand yet. Great, but then look on Private Money Club. I just saw today there's a bunch of deals, $30,000 and $40,000 deals paying 15+%. Get in the game, folks. And if you don't know how to play the game, just show up. Because we're here every single week. Matter of fact, we'll be back here at 4:30. And you really want to start lending money? Guess what? Tonight at 6 p.m., you probably already know about it, but at 6 p.m. tonight, I'll have Shauna put it in the chat. I'm doing a whole training on lending. I'm doing a whole training on lending. But I do want to give this one to you as a warning. Tonight's training, I'm going to try to sell you something. I know I'm not very good at it. I know I don't sell very well. I'm not the sales guy. I don't come out swinging. But tonight, I'm really going to try. So can you guys challenge me? Can I try to sell you something tonight? I'm going to sell you a ticket to an event in North Carolina called Money Tank. But here's the trade-off. For me to practice selling you a ticket to that event in North Carolina called Money Tank that you really need to be at, I'm going to teach you a whole bunch of stuff on how to lend money and how to do exactly what we teach every day about being the bank. I'm going to teach you some key important factors, and I'm going to show you how that lending will change your life. Let me leave you with this, and then I'm going to hit the questions. All of you have car payments. Some of you have college loan payments. Some of you have mortgage payments. Some of you have boat payments. How many of you love making all those payments? Does anyone love making those payments? Your car payment, your boat payment, your mortgage payment? Hate it. Laughing. No way. So in a fantasy world, wouldn't it just be better if somebody else just paid our bills for us? Wouldn't it? I mean, wouldn't it be way cooler if Jordy just paid my car payment for me every month? You know, or if Jordy just paid Vivi's private schooling bill every month? That would be pretty sweet, right? Yeah. So Mike's like, Chris, can I pay his? Sure. Sure. If you really want someone else to pay your bills, then join me tonight at 6 p.m. and I'll show you exactly how to do that. And Mike, hell, man, maybe I will pay for your car payment, but you got to show up tonight at 6 p.m. And you got to know I'm going to try to sell you a ticket at a very stupid discount to come to North Carolina in August to meet me, my team, and listen to a bunch of amazing folks tell you how everybody in that room is going to pay the rest of your bills. Now, Mike, I might just pay your car payment, but I bet you the other people that are going to be in that room at that Money Tank event are going to pay your other bills too. See, there's always somebody out there that wants to pay your bills because it's a win-win situation. I'm going to show you how that win-win works tonight at 6 o'clock. Fair enough? Every policy based on monthly or annual deposits, one-time possible. David, you can do both. You could do a one-time dump in, and then you can pick and choose how much you want to have the ability to deposit each month, each year. You're in full control of the mode on how you're going to make deposits to your policy. But I think your question is really, can I just put money in one time and then be done? You could, but why in the hell would you ever want to do that? And I don't mean to say that in a bad way, David, but if you put $1 in and you got $1.20 back, would you ever not want to put the dollar in? And then the next year, if you put $1 in, you got $1.30 back. Would you ever stop putting $1 in? And the next year, if you put $1 in and you got $1.50 back, would you stop putting the dollar in? No, of course you wouldn't. So why would you only want to put money in one time when every other dollar you put in after that first dollar, you make more than what you put in? More on that later, but that's something that it's difficult because a lot of us, you know, when you're first getting to learn about this, in your mind, you're still thinking of it as a payment. Like, oh, I got to pay that stupid whole life premium. No, you got to make that stupid deposit into your private bank is the way you need to be looking at it. And then you got to start saying, okay, for every deposit I make, because at the beginning it's going to feel weird. You're going to be like, oh, there's a payment. No, Chris said it's a premium deposit. It's a deposit. I got to think of it like a deposit. But then all of a sudden, eventually you'll see that every dollar you put in that deposit, you take more out than what you put in. And that just keeps going up. And oh, by the way, I didn't invent that either. That's just called compound interest, but it's really uninterrupted compound interest. Do you take a distribution of your business money first and then send it to the Fullers? Or is your business investing with Fullers? So great question, Jimmy. Both. On this side, this is my business accounts. The war chest is just like it's like a opportunity fund. And the reserve is just a reserve account. So these are owned by the business. Now, if I wanted to, I could take distributions from my company and put it into the policy, but I don't want to do that because I need distributions to be kept for other things that I wanted to spend money on. I don't want to pay tax. I want to minimize the tax. So I'm going to keep the business as the owner of these accounts. And when I lend the money to the Fullers put together, you know, the subscription agreement and everything else in the company name, which is Money School. So Money School is the one lending to the Fullers, and the Fullers are writing checks back to Money School, which is just building up this account again. So in my personal side, you know, when I'm funding my personal accounts, I'm doing it from W-2 and 1099 income. Okay, so that's taxable money. But now, and I'm not going to cover this, you know, I do the trust structure. So what's happening now is my trusts are going to own the policies and my trusts are going to fund the policies, which is a whole nother game that we don't have time to get into. But Jimmy, you kind of know what I'm talking about. So hopefully that answers that. All right. How do I get a hold of a mentor? Easy. So that's how you're going to book a call with one of our money mentors to talk about this in your own life. Interest paid on the loan from the policy isn't recaptured into the policy, correct? Interest paid on the loan from the policy. So David's asking, I think you're talking about this interest here. This interest goes to the insurance company. It's gone forever. Okay, so you give away 5%, but remember the insurance company is paying you with dividend anywhere between 5.2 and 6%, depending on the company. So they're paying you this gross. Okay, there's cost of insurance and things that come out of that, but this is what you're earning on every penny of the money, and this is what you're paying on the money. And then over here, this is what you're making on the money, depending on the opportunity. We went all different things. And then this recaptures down here. So yes, this money gone forever, going to the insurance company. Hopefully that answers that. Let's see. David said, right, but does not every policy max? Right, does not every policy max? We build every policy to the max, to what they call the MEC limit. Usually the policies that we're going to design are only going to have a threshold to put maybe 100, 200, at most $1,000 more on a really big policy in, because we're going to build it right to the max. Hopefully I answered that properly for you there, David. Jimmy said, then did you have to start a business account with 100,000 or did they just let you piggyback the Oh, great question. So this is, oh my God, I'm so glad he asked that. I didn't know this. So we all know that the Fullers, it's $100,000 minimum. Okay, this is how much you have to put with them to start. Now I lend money to the Fullers personally, and I started with 100. I got more than that now. I'm a couple $100,000, but this is where I started at the minimum. And then I also have business accounts, which we just went over, which I also do. But the business accounts, because I already had 100 personally with the Fullers, I could have done any amount. I could do 20 grand, I could do 50 grand. And actually, I just keep layering up. So like just today, I did another 100. Last week or the week before, I did 50 from the business account. So 50 and 100. But you see, once I've already met my 100,000, whether it's personal or business, consider it householding. So they're going to household this fund. So if you got 100 in personally, you can put any dollar amount business. Or if you got 100 in business, you can put any amount personal. Great question. I'm surprised I never talked about that. So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.